So let's start and good morning, everyone. Thanks for joining on Saturday morning and welcome to this 12th session of Niveshakon se Samvaad. So once again, thank you so much for all the cooperation, your support, feedback that really help us to reach this 12th session of Niveshakon se Samvaad. This platform is meant for the value addition, and as name suggests, Samvaad, it's going to be the interactive session. In current market scenario, right, when me or my colleagues, whenever we are in touch with you in person, there is a one common feedback or the common dialogue what we have, where to invest at this level. समझ में नहीं आ रहा है, सब महंगा लग रहा है. Precisely after changes in debt taxations, where to park our long-term debt money, whether I should buy equity, debt, or gold at this level. So to answer all these questions, today we have none other than Mr. Vishal Gajwani. Mr. Vishal, with over 15 years of experience in equity research and portfolio management, he has an extensive experience of managing equity portfolios across investment cycles. He, along with his team, is accredited with conducting differentiated market studies, capturing interesting insights on various aspects of investing, translating into superlative performance track record. He's a gold medalist chartered accountant and holds a master degree in commerce from MS University of Baroda. Vishal received 4 gold medals, including the Chancellor's Gold Medal for topping the Master of Commerce exam. He's also CFA charter holder from the CFA Institute, USA. And there is one more thing which is not included in his profile, but I'm taking a liberty and saying he's a mastermind behind our 2 important schemes, which is the BAF, Balance Advantage Fund, and the Small Cap Fund. So Vishal, welcome to this session. Thanks for joining.
Thank you, Amit, and thanks for the lovely introduction.
Yeah, thank you. So Vishal, quickly, as everyone is there, वो कहते हैं ना कि श्री गणेशा होता है. So first is everyone wants to understand outlook on market, precisely India equities as an asset class. How do you see with reference to next 3 to 5 years? Which could be those positive triggers? Which could be the negative triggers?
Sure. I think if I look at the macro outlook, the way we are placed, clearly we have seen last 1.5 to 2 years, actually 2.5 to 3 years from the COVID lows, the markets have done really well, led by reflation after COVID. So post-pandemic, there was a reflation rally, and we saw liquidity injection by most of the governments, including US, Europe, India. All this money went into asset classes and led to the reflation rally, which happened over the last 3 years across asset classes. And again, as we speak today, Indian markets are possibly at very close to all-time highs, and particularly small and mid caps have rallied in the last 3 months in a big way. So clearly, I think at the moment we are pricing in lots of positives as we speak. And also, if we look at how the market outlook has changed, if I look at last 2-3 years perspective, we have seen that interest rates have gone up by 400 to 500 basis points in US, which is the steepest increase in interest rates that we have seen in the last 1.5 years. The easy money policy is behind as we speak. All this led to the market stabilizing for the last 1.5 years. Markets were not going anywhere. But we saw the RBI pausing on the rates just a couple of months back, 2-3 months back, possibly in March, which is where again the rally started in Indian equity markets. And even globally, Fed has been talking about the pause in interest rates, which has again led to US markets starting to do well on a calendar year to date basis. So this calendar year, again, we have seen US markets do well. India over the last 3 months coming back after the pause that we have seen announced by the central bankers. Going forward, we believe that the risk reward seems to be balanced. Valuations are slightly higher than the long-term averages. So that's on the valuation side. And the rally has played out quite a bit. So from here on, from these levels, expecting high double-digit returns from equity markets would be difficult. Now, one shouldn't be expecting high double-digit returns from equities. Equities will deliver decent returns from a 3 to 5 years perspective, no doubt about it. But there could be years of single-digit returns on equity markets because the valuations are slightly higher than mean. And therefore, in this context, it's very important to have the proper asset allocation in place, where one is looking at a basket of equities, debt, and debt also is now starting to look attractive in terms of returns. So therefore, one should look at diversifying across equity, debt, and even commodities, where gold has actually been doing quite well. So that's our view. Equities, from a 3 to 5 years perspective, will deliver good results, good returns. In the near term, because of the strong rally which has happened, one shouldn't expect very strong returns from these levels.
Thanks. Next one is let's jump to the topic now quickly. What is the philosophy of our balance advantage fund and how it works?
Yeah, so for that, I will share the presentation of Balance Advantage to take you all through a few slides on the philosophy and strategy of Balance Advantage Fund. If you look at historically how the money returns have come in equity markets, we have seen when the PE multiple, starting PE multiple is lower, average future 3-year returns are pretty high. At a 14 PE multiple trailing for the index, the next 3-year returns are 37% annualized, each year 37% for the next 3 years. And this return keeps on coming down as the starting PE multiple goes up. And here, when the starting PE multiple is about 25 PE multiple for the index, the next 3-year returns are 8% annualized for the next 3 years. And therefore, there is merit to allocate more to equities at lower PE multiple and vice versa. What we have done in our Balance Advantage Fund is that we again have used this same framework where if the PE multiple is lower than 14 PE, then the net equity exposure is higher at 80% to 100%. And as the PE multiple goes up, the net equity exposure ranges keep on coming down. At a higher PE multiple of 25 times, the net equity exposure falls to 0 to 40%. And if you look at historically how this has helped us, the same framework, you would see on the right-hand side in this particular chart that the yellow line is the PE multiple line, S&P BSE 100 adjusted PE, while the red line is the net equity exposure. As the yellow line has gone up, our red line has gone down, which is equity exposure has gone down, while debt and arbitrage has gone up. In January 2018, at the peak of the market, index multiples were pretty high, and our equity allocation was below 40%. And post January 2018, we all know next 2 years were really bad for equity markets, where the large cap indices corrected, but small and mid cap corrected even sharply from Jan 2018 levels. So clearly during those times, our equity exposure was lower, which helped the investors. As we see, the PE multiple kept on coming down as the markets corrected. And during this phase, the PE multiples collapsed due to the COVID fall in March, April 2020. So during that time, we used that time to increase net equity allocation all the way up to 80%. By June of 2020, we were 80% into equities since the markets were cheap and the PE multiples have fallen below 15 PE multiple for the index. And we used this opportunity to take the equity allocation all the way up to 80%. Post which, as the markets kept on going up and yet the PE multiples kept on expanding, we gradually reduced net equity exposure into the fund. So this is the framework that we use for dynamically managing asset allocation between equity and debt. We have also introduced an asset allocation model recently, because if you look at today's PE multiple, today the PE multiple is 22 times roughly. And the range that is available to us is 30% to 60%. So within this range, where exactly we should be, that is decided by the asset allocation model, which looks at 8 different variables classified into 3 categories: valuation ratios, trend ratios, and volatility ratios. Valuation ratios have the same valuations, same ratios like price to earning, price to book, and yield gap, which are again all 3 are valuation indicators. Yield gap is an interesting one because it looks at the difference between earnings yield and debt yield. if the earnings yield is lower than debt yield, and the gap is higher, then that's not good. As the gap bridges, it's good for equity markets. So those are the valuation multiples. The second category is spend ratios, which look at what is the momentum in the markets. Is the momentum positive or negative? And one interesting ratio here is copper to gold. Copper is an industrial commodity, and therefore, if copper does well, it is believed that industrial activity is doing quite well, which is good for markets. While if gold is doing well, gold is a hedge commodity. It's a defensive commodity. So people buy gold when they are unsure of the markets, when they are unsure of inflation. And therefore, gold is a hedge commodity, defensive commodity. Copper doing better than gold is a positive indicator, while gold doing better than copper is a negative or bearish indicator. The last one is volatility ratios for India as well as US. Lower volatility is better for the markets and vice versa. All these 8 ratios are combined together into a consolidated score, which gives us exact equity allocation between the range that we spoke about. As we speak, the range is 30 to 60%. So within that, exactly where we should be is decided by this framework. So that's on the asset allocation model that we use.
I think this is very interesting, Vishal, and I think this is a very good insight that how the BAF has reacted in the volatile market. How is the current portfolio position?
Sure. So if you look at the portfolio positioning, before that, I think on the debt side of it, very quickly, on the debt side also, our endeavor is not to take too much risk, because fund is meant for conservative investors. So here, if you look at the duration, it is 1.25, 1.28 in that range. So we are not taking risk on the duration side, neither on the credit side. So it's an accrual strategy essentially, and almost 95% of the funds are into safe assets. Almost 100% is safe assets, and 95% is super safe, and 5% is AA. So that's the portfolio positioning on the debt side.
Right.
Coming to equity positioning, here you will see that we are overweight on sectors like automobile, financial services, healthcare, and FMCG. These are the 4 sectors that we are overweight. And while we are underweight on oil and gas, IT services, metals, and consumer discretionary. That is how the positioning is.
One thing, how you differentiate, okay, or how you rather consolidate equity, debt, and the arbitrage part also. So just I'm picking one question because taxation is equity. So how you balance that? Yeah.
Sure. So yes, that's a good question, because here the advantage for the investor is that though we have on an average 50% into equities, still the taxation part is equity taxation for the entire 100% of returns. So the point is that equity, net equity keeps on going up and down, but the gross equity remains above 65%, which is why the taxation remains equity taxation. And we try to hedge the portfolio through arbitrage positions, as well as through nifty put options. So these are the devices that we use to hedge the portfolio to reduce equity exposure, net equity exposure, while the gross remains high, and the debt portion remains 25 to 30% of the fund. So that's the split between equity, arbitrage, and debt. As we speak today, equity would be 56%, arbitrage would be around 15-20%, and balance would be debt.
Thanks. So moving to the next one, Vishal. So multi-asset category. Okay, MAF. And we have seen that, because of the current market environment, because people ask whether to invest in debt because interest rates are looking in, lucrative. Gold has, we have seen surge in the gold prices. So rather than, shuffling our portfolio from one asset class to another class. Okay, I think this category is gearing up. So what's your view on this and philosophy behind our MAF?
Sure. I'll again share a small brief presentation on the same on our multi-asset allocation fund. So I think this is a very interesting slide in terms of how the different asset classes perform during different cycles of the market. So what we have done here is that we are basically, just one second. Yeah. So we are, the green dots that you can see are the dots of real GDP growth in that year. So for example, 2005, 6, 7, till January 2008, the real GDP growth was very strong at 8% odd. So therefore, the green dots are slightly higher. Post which the GDP growth fell to almost 4%, where the green dot has come down. And again, this was January 2009. Post which again GDP growth started clawing back. So, so basically, we have figured out uh, the phases of the market where the GDP growth was very strong, which is depicted in green, while the phases where the GDP growth came down are marked in pink. So these are the two colors that we have used, light green and pink, to show the phases of the market where the real GDP growth was strong or weak. During strong GDP growth times, you would see that equities have given very strong returns at 215%, and during 2005 to 8. Fixed income generated 17%, and gold has delivered 75%. These are absolute returns during this period of the market. Post which, as the markets corrected during the when the GDP growth came off, equities delivered minus 50%. Fixed income delivered positive 12, while gold actually delivered positive 42%. So during the pink phases of the markets where the GDP growth contracted, gold has actually given stronger returns than even fixed income. Again, if you look at this phase of the market, gold has delivered positive 30%, while fixed income has delivered 16%. Again, recently from January 2018, where we talked about the GDP growth came off, even at that time, gold has delivered positive 72%, much higher than equities and fixed income. And therefore, there is merit to hold different asset classes into one's portfolio. And let us look at what it does to the portfolio when you have different asset classes. In this slide, you can see that equities have a negative correlation with gold, while the correlation with fixed income is very limited, just 0.1%, but it's a positive correlation. While with gold, it is a negative correlation. What it means is that if equities go down, gold actually goes up, and which is what helps investors to generate additional returns where they have all the three categories into one fund. Now, this is an interesting chart of long-term returns of different asset classes. So the first one, the highest one is equities on a longer term basis for the last 2 decades, from 2003 to 2023. Equities has generated 17% annualized, which is the best among all asset classes. But as one can see, this is coming along with a lot of volatility and downside. To reduce that volatility, if you look at other asset classes like gold, which is yellow line, has given 11% CAGR. And fixed income, which is very, very stable, has given 7% annualized, 7% CAGR. So fixed income is very stable, but the returns are lower. If you actually combine all three asset classes at 65% equity, 20% debt, and 15% gold in this ratio, then you will, the results that you will get is the dark green line, which is 15% annualized, 15% CAGR for the last 2 decades, and with very less volatility and very less downside drawdowns. And that's the advantage of our multi-asset allocation fund, which combines all three: equity, gold, and debt. On the downside as well, the equity downside is around 9% average drawdowns. Gold is 10% drawdowns, while multi-asset portfolio historically has given 4%, minus 4% drawdowns on an average. So clearly experience of the investors is going to be better in case of a multi-asset allocation fund. In terms of, again, if I look at the same in terms of annualized returns of the multi-asset allocation fund over 15 years, 10 years, 7 years, 5 years, all time frames, annualized returns are double digit for the multi-asset allocation fund, except for the last 1 year, which again should improve as equities have started to do well. This is a bit dated slide. This is uh, uh, dated 30th April, post which we have seen strong rally in the markets for the last 1.5 months. So the last 1 year returns has also become positive for this category. So clearly, multi-asset gives double-digit returns across time frames with much lower volatility, and volatility is much lower, and therefore Sharpe ratio is positive. So that's on the advantages of multi-asset category. If we look at our portfolio positioning in this fund, we have 65 to 80% net equity. Uh, Fixed income is 10 to 25%, and commodities, which includes gold as well as silver, will be 10 to 25%. Then we have optionality to also invest in REITs and international equity up to 10% and 20% respectively. So that's how the multi-asset positioning of the fund is created.
I just want to reiterate that helping any investor to have this asset allocation in a single scheme with an equity taxation.
Right.
Yeah, good. I think you can see the Q&As, just it's pouring in. I think we have to jump on the questions and answers, and let's touch base all our points to that.
Sure.
First, Mr. Gulraj Chugani is asking, for your net equity allocation in BAB, do you see only P or interest rates are ignored?
Yeah, that's a good question. So over there, again, let me just put up one slide to clarify the point. So on the balance advantage side, as I mentioned, P multiple is the starting point, which helps us decide the equity exposure ranges. Today's P multiple is 22. Therefore, the net equity exposure range would be 30% to 60%. But within this range, where we should exactly be, is decided by these 8 parameters, which looks at valuation ratios, trend ratios, and volatility ratios. Now, interest rates intuitively are a very important part of deciding what the PE multiple should be and what is the outlook on the markets. As the interest rates go up, the ask of the investors goes up in terms of equity returns. And therefore, let's say interest rate is 6% in the economy, then the earnings PE multiple expected by the market would be higher. As the interest rates go up, let's say to 10%, then the PE multiples actually contract in the equity markets, right? So therefore, to gauge that sentiment and to gauge where we are in the interest rate cycle, we look at the yield gap, which is a part of valuation ratios. Now, let me just give an example on that front. What is yield gap? Suppose the GSEC yield, government securities yield, is 8%. And PE multiple of the market is 25 PE multiple. So if you inverse the PE multiple, 25 PE multiple, you inverse it, then it becomes 100 by 25, which is 4% yield. So it is at 4% yield on equities, while the debt is giving 8% yield. GSEC is 8%. Therefore, the yield gap is 4%. 8 minus 4 becomes 4% yield gap, which is pretty high yield gap. So when equities are giving just 4% yield and debt is giving 8%, which is very lucrative, why should we be in equities? Therefore, money moves out of equities at a 25 PE multiple and goes into debt, which is 8% yield. But then suppose the situation changes tomorrow. PE multiple contracts from 25 PE multiple, it comes down to 20. So 20 PE means what? 100 by 20 is 5% yield. Therefore, equities have started giving 5% yield versus 4% yield earlier. And if debt yields come off because the interest rates stabilize or interest rates go down and debt yields come off to, let's say, 7%, which is the case now, 7.5. So now equities are giving 5% yield while debt is giving 7% yield. So for the yield gap is just 2%, which was 4% earlier. Therefore, high yield gap is bad for equity markets. Lower yield gap is good for equity markets. So that's how we use the interest rates and the difference between earnings yield and debt yield to decide how much we should put into equity markets. I hope that clarifies the question on whether we use interest rates to decide our equity allocation.
Sure. Thanks. Mr. Vaibhav Karandikar is asking, for balance advantage fund, it was mentioned that equity exposure is at 40% when P is high. Should the exposure not be above 65% considering the taxation?
Right.
We just want to understand how you manage that pure equity one and arbitrage. Yeah.
Got it. Got it. So, yes. So, equity exposure, when I mentioned was 40% when the PE multiple was pretty high. What I was mentioning, Mr. Weber, is that I was talking about net equity exposure, which was 40%. Well, the gross, even at that point of time, was 65%. So the gross equity exposure was 65, and we hedged the balance 25% through arbitrage as well as Nifty puts to reach to the net equity exposure of 40%, which means that even when the net was 40, the fund was still eligible for equity taxation.
Okay, that's good. Mr. Jigar is asking, how do you differentiate between HDFC BAF versus yours?
Yeah. So I think if I look at HDFC BAF in the past, what I understand, it was not following dynamic asset allocation in the past. Possibly last 1 year, they have also started following dynamic asset allocation, where they are changing net equity allocation based on market outlook. So earlier, the difference was that it was static asset allocation, while ours was truly dynamic. Possibly now they have also started doing a dynamic asset allocation. But the difference, more importantly, remains on strategy front of it. The asset on the equity part. If you look at which are the sectors we are overweight, underweight, etc., will be different. And also the model which is used to decide asset allocation will be different. So these are the two things. The model that we have, which is our proprietary model, which will be different. And the within equities, how are we adding value? How are we generating alpha? So for example, let me give you an example. Within the FMCG, our top weight in the last 2 years was a stock called ITC. And ITC was almost 5-6% weight of the fund on the equity side of it, which was the highest amongst the peer group. And we all know last 2 years how ITC has performed. Similarly, cement, we have been overweight over the last 1.5 years, which has also added value to the fund. So these are the ways that we try to add value by having the right asset allocation through the model, as well as within equities to get the right sector allocation in terms of overweight, underweight.
Sure. Mr. Sunil Doshi is asking, is it advisable to do systematic transfer plan from liquid fund to the BAF or to the multi-asset funds?
Right. I think that's a very good strategy to do of a systematic transfer plan into balance advantage and multi-asset funds, because these are evergreen funds. In fact, if you look at these funds, you can do all three things. One is systematic transfer plan into the funds from liquid to these funds. Second is you can put lump sums also. Even at the peak of the market, you can put lump sum because the net equity exposure will be lower. So asset allocation is anyways being taken care of. So you can put lump sum also in this category. And also you can go for systematic withdrawal plan because the NAV is more stable than equity funds. NAV drawdowns are lower. Therefore, you can also go for systematic withdrawal plan from these funds.
Mr. Mohan is asking that standard deviation of the BAF and the asset allocation funds are higher than long-term debt and even yield funds. So volatility is not so favorable. What's your view on this?
Yeah, so if one compares these two pure debt funds, then the inference is correct that the standard deviation would not be as good as pure debt funds. However, if you look at any investor's asset allocation, how the investor parks his money, every investor would have some or the other asset allocation plan applicable for him or her. No one is going to put all the money that he has into debt funds or all the money that he has into equity funds, because both are the two extremes of the strategy. One is very extremely conservative, where 100% is debt, and the other is extremely aggressive, where 100% is equities. Everybody has a mix of asset allocation between debt, equity, and other asset classes. And therefore, we believe that, and people do this manually in terms of deciding where to invest what. What we do here is scientifically based on evidence, based on regression analysis. We know what is the best asset allocation at what stage of the market. When the market P multiple expensive, we should have lesser equities, etc., etc. All that empirical evidence that we have, based on that, we have decided asset allocation. And that's the advantage the investor gets by investing in these funds, which is BEF and asset allocation funds, where the investor gets exposure to all the asset classes at one go. And these are all thought through, thoroughly thought through, researched allocations. And lastly, you get equity taxation for the entire 100% of returns. These are the advantages why investors have flocked to this category, despite the standard deviation or drawdowns being higher than pure debt funds, because investors would always want a basket of everything. I hope that answers the question.
Yeah, sure. Mr. Rajiv Shukla is asking, would it be wise to allocate at least 30-40% of my portfolio to bonds or the NCD for the long term, say next about 7-8 years, as interest rates are higher currently? I'm touching 60 years of age. So please advise. So I will slightly edit this question. Of course, I mean, at this current market scenario, is it advisable, considering the taxation, to invest in bond NCD vis-a-vis BAF or MAF? Not MAF, but BAF, considering, lower equity exposure of the sometimes, because time horizon is 7-8 years. How it could be beneficial? I need your views on both the sides.
Sure. I think with the recent change in tax regime that we have seen, pure debt funds, the lucrativeness or attractiveness is actually reduced because of the taxation which has gone up. When tax rate is actually increased to maximum marginal tax rate, it depends upon if you fall in that category of maximum marginal tax rate, then it is advisable for you to look at tax efficient ways of investing into funds where the volatility is lower, but at the same time tax rate is also lower. So if you were to hypothetically choose a pure bond fund or NCD fund, the taxation would be higher at possibly maximum marginal rate. While if you look at multi-asset allocation fund or for that matter, balance advantage, and if you hold for more than 1 year, the tax rate falls to 10%. And I think that's a huge arbitrage available from a tax planning perspective to save tax.
Sure. Just slightly different question, but still I want you to answer on this, that I've invested through a SIP route a tax saving fund more than 3 years back, and return is just about 6-7%. I had very bad experience about particular the schemes. What's your take on this? Should I stay away from Aditya Birla Sun Life equity schemes, or what as a fund house we are doing to improve the performance?
Right. So on the tax saver fund that we have, the returns experience of the investors unfortunately hasn't been good in the past.
Right.
The reason it became really big was because it did really well in the past in terms of performance and was possibly top decile for many years. However, having said that, last 3 years experience of the investors hasn't been good. And we have seen the fund performance lagging behind the benchmark. What we have done as an AMC is that we have taken concrete steps to address that situation. One is that there has been change in fund management. Mr. Atul Penkar is the new fund manager. He has done a lot of changes in the fund, and which is what we believe will start reflecting in the fund performance as we go along. So I think we are clearly cognizant of investor feedback here and experience of investors, and we are doing our level best to make sure that we address the situation and get back this fund on track as we move forward.
Thanks. Mr. Pradeep Roy is asking, I've invested in your BAF. Thank you so much for this confidence. So whether to hold, redeem or switch at this level? Fourth option he has not asked whether I should invest additional purchase. Yeah, but still.
Yeah. So I think, so it depends upon your um, time frame, and also what is your return expectation. So balance advantage as a category, and if you look at our fund, provides a decent upside, a reasonable upside with very strong drawdown protection. So if you as an investor are looking for that, I think this is the best category to be in, and the fund within the category has been doing really well. So we would advise you to hold on or possibly add more, as Mr. Amit mentioned. However, if you want uh, more aggressive funds, then we have some more aggressive funds, pure equity funds in our bouquet, and we would advise you to go for those funds. However, at this moment, since the market multiples, PE multiples are slightly higher, and uh, the markets have done really well over the last 2 years, we would advise you to go for a balanced scheme, or a scheme where you have a mix of hybrid schemes, mix of debt and equity, rather than pure equity at these levels. Uh, uh, but clearly, let's say if the markets fall, etc., and if you want more aggressive funds, you can always go for pure equity. Balanced advantages category is an evergreen category because of dynamic asset allocation. So here you don't need to worry about asset allocation and whether my money is secured or not, because we are taking those calls on a regular basis of how much equity, etc. I hope that answers.
Yes. Mr. Shamal Datta is asking, retrospectively, this looks good. How would your fund promote the movement in these different asset classes?
Preempt the movement, possibly, is what Mr. Shamal meant.
Right.
So, preempting the movement in these different asset classes. So, what we have done is that we have actually looked at the last 2 or 3 decades of uh, of these movements in these asset classes and what drives these movements. And based on that, we came up with these 8 parameters and variables that we thought are the most important to preempt how the markets will move. For example, valuations, we believe price to earning, price to book, yield gap are the ratios that decide the future movement of the equity markets, how expensive the markets are today, and therefore how the returns will be later on. If the markets are expensive, then of course returns expectation should be limited. So these 8 variables, 3 of them into valuation category, 3 of them into momentum category, and the balance to in volatility category. All these 8 parameters in the past 3 decades have performed really well from a backtesting angle. And that's what gives us confidence that no, while in the past we have done well, but this framework will help us do well going forward as well.
Sure. Mr. Jigar is asking, is there a comparison between returns of BAF or MAF? I will once again edit this. Is it like apple to apple comparison of comparing BAF with MAF?
Yeah, so that's an interesting question, because both these funds provide asset allocation benefit. They also provide the same benefit of equity taxation.
Right.
In a way, they are comparable on these 2 counts. However, there are certain nuances, and for which each investor has to figure out for himself or herself which one is better for them. In BAF, you have dynamic asset allocation, where asset allocation keeps on changing. In multi-asset allocation fund, you have benefit of exposure to debt, to gold, silver, and other asset classes as well, apart from equity and debt. So these are the 2 important differences that one needs to keep in mind. Let's say if you have, as an investor, if you are already having a lot of physical gold, then you should go for BAF because you already have gold exposure through physical gold.
Sure.
But if you don't have physical gold, and if you want exposure to that because you are thinking of your child's marriage after 10 years, 5 years, 20 years, then it's better to go for multi-asset allocation fund because you have exposure to gold also over there, silver also there. So based on individual preferences, you can decide.
Sure. Mr. Birendra Prasad has raised his hand. I request you to put the question. So I refer to, though you have answered it, just I'm taking this question for him. How do you compare your BAF with the HDFC ones?
Yeah. So that's something that we come very
Yes.
answered in the previous question.
Yeah,
Yeah. I hope Mr. Birendra got that answer.
absolutely. For multi-asset allocation, if you are buying gold ETF, then the expense ratio of that scheme will also be applicable. Why investors should not buy three schemes like equity, debt, and gold ETF and achieve multi-asset advantage?
Yeah. So in that case, what will happen is that it will not be very tax efficient, firstly, because debt will be taxed at 30% in that range. Gold will also be taxed at higher rate, possibly 20% if I'm not wrong, or maybe 20% plus. Uh, while within multi-asset allocation fund, even debt and gold will be taxed at 10% if you remain invested for more than 1 year. So that's one obvious advantage where taxation is pretty favorable for this category. And second is there is leeway to change asset allocation within multi-asset allocation fund also in extreme situations like COVID or some other extreme situations. Uh, so the benefit of changing asset allocation by the use of extra expert fund management skills is also available through multi-asset allocation fund.
Okay. Mr. Amit is asking, do you think gold as an asset class has been manipulated by few big banks in the USA? All the central banks are adding gold to the reserves, including RBI.
Interesting question in terms of uh, how it has been manipulated, if at all, by few US banks. Uh, Firstly, I think it is not in the interest of the US Fed if gold does well, because uh, we all know dollar is a reserve currency of the world. So all central bankers globally, including China, India, and big ones, other big ones, European central bankers, have invested their reserves into the US Fed Treasury securities. Uh, and gold is also a part of allocation, but US Fed Treasury is a bigger part. And if gold were to do well tomorrow, then central bankers may switch more towards gold and less towards US Fed's securities. In a way, therefore, I think gold being manipulated by few US banks looks unlikely because it is not in their interest to increase the gold prices. But at the same time, uh, central bankers around the world, including RBI, understand the importance to diversify their reserves. Uh, and you will, of course, have US Fed securities, US government securities. But at the same time, you have to diversify, which is why gold plays an important part in that diversification drive. And that's why gold is very important from regulator, from um, reserve bank's perspective, any central bank perspective, to diversify their holdings.
Okay.
Yeah.
Mr. Vinayak is asking why ABSL Equity Advantage Fund is doing slightly less than Aditya Birla Sun Life Frontline Equity Fund.
Right. So I think in this case, Equity Advantage Fund has gone through a rough patch. If you look at it for 1 year or so, post this Ukraine-Russia war, we saw this fund getting impacted a bit because of the positioning. It had higher weight in IT services, which got impacted, and higher weight in certain consumer discretionary sectors, which got impacted after the war because commodity prices went through the roof. So this fund got impacted for a short period. But I think I'm happy to share that there has been a change in fund management for this fund as well. And post that, last 3 months to 6 months have been very exceptionally good for this fund. And the fund performance is coming back on track very strongly. So while it might be lower than Frontline at the moment for a 1 year basis, but we hope that both these funds do well going forward. And this fund has already started to do well in the last 3 to 6 months as we speak.
Sure. Mr. Rishabh is asking, India is in a sweet spot, which may mean that P's may remain high for a longer period of the time. How will the fund adapt to this?
Right. So no, that is in a way that's what we are. Most of the investors are believing that the PE multiples might be high, but they may remain higher for longer. Uh, and the expectation is that the earnings growth of the companies will remain stronger, especially with the pause in the interest rate hike. That view has got strengthened that the markets will do well and the earnings growth will be strong because the rate hikes have been paused. And that's why uh, uh, higher PEs for longer is possible. One cannot rule out that. But the point is PE multiple expansion from these levels is limited, going to be limited. And therefore return expectations, while they are not negative from equities, but they cannot be very strong at 20% annualized also. Maybe 8 to 10% annualized over the next couple of years is very much possible in equities. And therefore, we are suggesting to investors that you look at proper mix of asset allocation between equity, debt, and gold.
Right. Mr. Mohan is asking, shall we wait for monsoon to get over to get better valuations by September 23?
Yeah, the only risk in that thing is that, by the way, if you look at the last 2 decades of how markets have behaved, and we have this study done, we can share that with you. El Nino, whenever that El Nino has happened, it has impacted agriculture, rural incomes, and therefore rural spending has got impacted, which is a fact. But El Nino has very limited correlation with equity markets. Despite El Nino, markets may go up because rural contribution to equity markets is limited. Certain segments may get impacted, but overall equity markets may not get impacted, even if the monsoons are bad and rural economy is not doing well. And therefore, I think there is no one-to-one direct correlation is not there. And therefore, I think one has to take a nuanced view and look at equity markets. El Nino is one of the risks, along with many other risks for equity markets. That's how one should look at it.
Sure. Requesting Mr. Ketan Jani, you have raised your hand, requesting to put your question in the Q&A box. Quicker to the next one, Mr. Parag is asking for the MAF, what would you recommend as the ideal minimum holding period?
Yeah. So here I think for multi-asset allocation fund, I think 3 years is what we 3 to 5 years is what we would suggest as a holding period here, because an asset class entire cycle of asset class, if that were to you have to look at that, you will see the benefit over 3 to 5 years of the entire cycle playing out for the asset class.
Right. Mr. Shamal is asking, I am invested in your BAF for a retired person who is looking for a stable income with the principal being relatively secure. Which of the two schemes would be more appropriate? And considering, of course, equity taxation because it's a long term. Yeah.
Right. So I think you can look to invest, diversify into both these schemes based on your individual asset allocation, which is already there. Let's say if you have physical gold already with you, then you can continue with balanced advantage fund. But if you, for whatever reasons, if you don't have physical gold or you want exposure to that category, then multi-asset allocation seems to be a good option for you as an investor. So I think it depends upon personal choice and preference, and more or less both are well diversified funds.
Sure. Mr. Dharam and Ms. Anuradha is asking, first one is, I think, your view on the frontline equity fund, whether we should continue or switch to some, other funds. And second one, Ms. Anuradha is asking about the mid-cap fund performance, which is not up to the mark. And as a fund house, what we are doing.
Right.
Compared to the peers. Yes.
Right. I think firstly, to answer Mr. Dharam's question on frontline equity fund. Now, frontline, if you look at it, the mandate is pure large cap investing. So almost 85% of the fund would be large caps. Balance 10 to 15% would be mid caps. And this is a fund which is basically uh, very risk averse from a market cap mix perspective. We are not taking too much risk on a small and mid cap side here. It has been consistently in Q1, Q2 across time frames for us. So this fund, if you have let's say time frame of 3 to 5 years, you should continue to hold frontline equity fund. But if you are worried about the short-term performance of equity markets and your investment horizon, you are looking at next 6 months to 1 year, then you should switch to balanced advantage or to pure debt funds. But if your investment time frame is 3 years plus, then frontline remains really good.
Sure. Mr. Deepak is asking any suggestion for NRIs?
Yeah. So I think before that, on question on mid cap underperformance, I think we are working on that, and we have basically done a lot of changes in terms of investment processes. Got even the fund manager is changed in mid cap fund. There is a new fund manager called, of course, Mr. Anil Shah is there for us for a long time, but he recently started managing the mid cap fund, and we hope under his leadership, the fund will turn around very quickly and very strongly as we move forward. And apart from that, we have also done certain changes in terms of processes, how to identify small and mid cap stocks. Also in terms of research team, a lot of changes have happened. A lot of new additions have happened in the research team, especially for small and mid cap category. And which is what all these things are cumulatively giving us confidence that both these small and mid cap categories should do really well for us as an AMC as we move on. And that's a very strong agenda, which is being driven by right from the CEO level. There's an agenda being driven that we need to improve and be in top quartile in these two categories, small and mid caps.
Sure. Quickly, the next one from Mr. Deepak. Any suggestion for NRIs or the OCI holders? I think they can invest in any schemes.
Maybe you can better advise.
Absolutely. Mr. Abhay is saying for the taxation purpose, how can I access documentation or the evidence that the gross investment in the equity in the BAF is greater than 65%?
Yeah. So, Mr. Abhay, I think you don't have to worry about that in terms of documentation and evidence on that front. The category taxation is 65 is equity taxation for sure, and we basically as fund managers and an AMC have the responsibility to make sure that the gross is higher than 65%, and our data goes to the income tax department every year, showcasing how and we have very strong internal control systems in place with real-time tracking. So on a real-time basis, we are tracking that our exposure remains above 65%.
Sure.
So from that perspective, you don't have to worry about it. We are anyways doing it, and it is our responsibility as an AMC to make sure that we remain 65% plus on a gross basis.
Sure. Mr. Ketan is asking, I've been investing in mutual funds since many years. In those days, balanced funds were not so popular. So I made a thumb rule to invest in equity and did in 60-40% ratio respectively. Should I disinvest and invest in a hybrid funds?
Right. So I think your asset allocation, Mr. Ketan Bhai, has been 60-40, 60 in favor of equity and 40 in favor of debt over the years. And now I think, but what happens is that it's a passive asset allocation. And if you are looking forward to an active asset allocation, then balanced advantage is a good category. And here your debt might be being taxed at maximum marginal rate, possibly. The debt taxation might be higher for your 40% of the funds. And therefore, it's better to look at this category of BAF and multi-asset, where you can reduce your overall taxation by getting the same benefit.
Sure. These are the common questions I have with my investments in arbitrage or the liquid funds. How can I move to balance advantage for all the MAF? Of course, I mean, you can do systematic transfer plan or any switch can be do. The last one, I will take it for the positive of time that uh, I have following your small cap fund for last 3.5 years. I've been observed. This is from Mr. Ketan that I've been observed that I think performance is being bounced back precisely in last couple of months. So what you guys are doing differently, and what's your view on this fund? Whether I should invest in this active fund or whether I should invest in an index fund.
Right. That's an apt observation, firstly. And thanks for that, sharing that. So clearly, small cap fund has bounced back in the last 3 to 6 months very strongly. And as Mr. Amit mentioned, I personally look at small cap fund as well as balanced advantage funds. So in this case, what we have done is that we talked about the strategy changes in terms of how we look at small and mid caps from an identification perspective. So that is one big change that has happened, to have the right processes to identify the small and mid caps at the right time, and when they are undiscovered, so that we play the entire rally of PE multiple expansion in those stocks. So that is really the entire framework has changed. And if you look at the new stocks that we have bought in the last 1 year in the small cap fund, they have done really well, which have come from this framework perspective, from this filtration perspective. So therefore, all that has started to yield results in terms of fund performance being now visible. So the effort was going for the last 1.5 years, but the fruits of that effort have started to trickle in now, because the stocks that we purchased based on this filtration criteria, etc., have started to contribute well for the fund. And we are very hopeful that we will continue to maintain this performance as we go along. So as we speak, I think even till 9 months basis, the fund is Q1, Q2. The hope is that we should continue to focus on this improvement and show consistent performance on the small cap side.
Sure. I think thank you so much, Vishal. It's really informative. And thank you so much, all our investors who have joined from across the India, across the globe, because I've seen, a couple of NRIs have also joined. So thank you so much for joining on Saturday and being so interactive. I think crux of this conversation is definitely, I think BAF and the MAF, that balance advantage fund and the multi-asset category, is going to be the core part of the portfolio. And definitely in terms of getting the real returns, considering the inflation and the real returns and considering the taxation, these two categories can definitely add value to the individual portfolio. So thank you so much once again for joining, for having this interactive session, and see you in next session of our Niveshakon se Samvaad. So thank you so much. Thanks, Vishal.
Yeah, thank you, everyone. Yeah. Have a nice weekend to everyone.
Yes,
take care.
thank you.
See you.
Bye-bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। स्कीम संबंधी सभी दस्तावेजों को ध्यान से पढ़ें।